Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be taking a look at Booz Allen Hamilton stock. Now, this was a recent subscriber request, so shout out to you for leaving a comment on one of the videos asking for a specific stock. And if any of you guys watching the video right now do want to see a specific stock being featured in the future, make sure to leave it down in the comments below and I'll try my best to get to it. Now, I was out of town last weekend, so I didn't have a chance to post a video, and I've been pretty busy with work recently, but I wanted to make sure to get this video out this week as soon as possible, especially with earnings being released pretty recently. Now, because of the time constraints, this video will not be as long as some of my other videos on the channel, so if I did miss anything or if you guys have any more questions about the stock or anything in the video, make sure to leave them down below and I'll be sure to get to them. Now, in this video, we'll take a look at its recent stock price performance. We'll also cover some of its financial and dividend metrics, and we'll take a look at my individual holding within Booz Allen Hamilton. We'll also briefly cover some of the reasons the stock is down and take a look at their most recent investor presentation. Now, throughout the video, I'll give you guys my thoughts about the company and what I'm going to be doing with my personal holding in the position and whether I think it's a buy or a sell right now. If you do enjoy this type of content, consider subscribing to the channel. I post weekly investing content most of the time, so I'd really appreciate it. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Now, with that being said, let's start by taking a look at my portfolio dashboard. So just real quick, I have $50,893 invested and my current value is at $63,178, which gives me an unrealized gain of $12,285 or a total return of 24.14%. In total, I've earned $1,687 from dividends, which has been reinvested back into the companies that paid them out, and my yearly projected income going forward is $1,042. Now, my current portfolio is at 1.65%, and my yield on cost is at 2.05%. As you can see right here, these are the companies that make up my portfolio, which can also be seen right here in terms of their dividend yield compared to their yield on cost. My current cash position is around $8,105, so I've been looking to deploy the cash wherever I see opportunities, and if you can see right here, so far this year I've already deployed a good amount of cash at almost $16,000. Now, in terms of individual dividend payments, as you can see right here, Booz Allen Hamilton is one of my larger dividend payers, and that's because it's one of my largest positions in the portfolio. So taking a quick look at the stock price performance, we can see that just today it's down 4.69%, but if we zoom out and look at the 5-day graph, it's even worse, down almost 20%. Right after earnings, the company basically dipped down 17.5%. Now, in the past month, the stock price was actually doing well, and if we zoom out to the 6-month period, we can see that it's had a pretty tough time, but was starting to recover from March all the way until recently. Unfortunately, with the recent earnings report, we did see a steep correction in the stock price. In the past year, the company's down 32%, and in the past 5 years, the company is positive, up 31%, but at some point was performing substantially better than this at more than double. So some metrics that I quickly want to hit on here is the market cap. The company's at $13 billion with a market cap, so it's a fairly small company compared to some of the other defense conglomerates. And we can see right here the PE ratio is at 14.4, which is down substantially from just a couple months ago. Up until recently, the company tended to trade at a pretty significant premium, higher than a 20 PE, but because of the stock price correction, we have seen the PE ratio get compressed down to 14.5. Now, depending on where their earnings go, this could change pretty quickly, but right now, this does seem to be a pretty significant discount to the average. In terms of dividend yield, the company is trading at a higher dividend yield than usual at 2.1%, and the 52-week high is at 190, so just in terms of price alone, it is at almost half the price it was trading at its 52-week high. Now, the 52-week low was $101, which was just a couple months ago, and we're getting close to hitting that 52-week low once again. So in terms of my individual holdings within my portfolio, we can see right here that Booz Allen Hamilton is one of my worst performing companies within my portfolio, only being beat out by UnitedHealth, which we covered in my previous video. If you guys haven't yet checked out that video, I'll leave it linked right up here, and I'll also put it at the end of the video in the cards if you guys want to check it out. So these two companies right here have been pretty big L's so far. Now, filtering out for just Booz Allen Hamilton, we can see right here that my average price paid was $140 per share, and at the time I thought it was a pretty decent price. I actually started buying a little bit high at $155 per share, and of course I wish I would have waited a little bit longer, and so I tried to average down my cost basis, but it was difficult because I'd already invested so heavily into the company. The current price at $104 represents a 24.5% discount or a $1,000 unrealized loss so far. In total, I bought 32 shares, and with dividend reinvestments, it's at 32.193 shares, and my amount invested was $4,400, which puts it at one of my highest positions in the portfolio in terms of amount invested. Because of the unrealized losses, my current value is only at $3,300. Now, I'm not in a hurry for the stock price to correct on this position. Of course, it sucks being in the red, but if I do believe in the company long term, which we'll get into a little bit later in the video, then there's no reason to panic right now and sell. However, if the fundamentals are falling apart and my thesis is no longer valid, then it may be time to cut my losses and sell the position. In terms of my dividend earned, it's actually pretty low so far at $21.15. That's because my yield on cost was only 1.58%, but the current yield is 2.1% because of the decline in stock price. Now, every year going forward, I'm projected to be getting paid 70.82, and as long as they keep increasing these dividends and I keep reinvesting my dividends, this will go up over time. Now, in terms of portfolio allocation, it currently represents 5.3% of my position, but if it just went back to break even, it would be closer to 6 to 6.5%. Now, of course, any gains of the position could push the allocation up to 7, 8, or even 9%, like we've seen in companies like Uber and Google, which I hold in my portfolio. So real quick, taking a look at this article right here by the Wall Street Journal, we can see that they plan to cut 2,500 jobs after the company warned that it's feeling the effects of the crackdown on federal contracting. Basically, Booz Allen Hamilton has been hit pretty hard from some of their contracts being cut, and because of that, they're reacting and cutting about 7% of their workforce, which equals 2,500 jobs. Now, because of that slowdown, shares fell pretty significantly after their earnings report, which I honestly was not expecting going into it. Now, we'll cover this a little bit later, but I was not completely wrong. I expected the company to continue performing well, and in terms of the performance for the past quarter, the one they just reported for, it was actually really strong. Now, the bigger problem and what sent the stock crashing was both their guidance for the next quarter and their guidance for the next year. Stock price is forward-looking, so the aggressive cut in guidance explains why the stock price declined so drastically. Now, what makes Booz Allen Hamilton more vulnerable than a lot of other companies to these cuts is that 98% of its $12 billion in annual revenue come from government-related work. Now, the company did expect some disruption, and I did as well, but this is much more drastic than I anticipated. Now, the majority of the cuts affected their civilian sector, which honestly is something I did not take into account. I was expecting the defense and intelligence sector to stay strong, which it did, but the civilian sector still makes up a lot of their revenues. Now, jumping into their latest investor presentation, we can take a look at some of the specific metrics that they covered. Now, if you guys did watch my previous video on Booz Allen Hamilton where I covered one of their investor presentations, you can tell this is a little bit different of a presentation style than they were doing before. And honestly, I much prefer the older style. I'm not a big fan of this one, so I hope they go back to that older style of presentation. It was much more helpful and thorough. Now, in terms of their fiscal year 2025 highlights, we can see that they performed very well. Their revenue grew 12.4%, which is very strong. Their adjusted EBITDA grew almost 12%, and their adjusted diluted earnings per share grew 15.5%. Now, their backlog during this time also grew by 15.3%, which is fantastic. Now, something that's really important to me is their free cash flow. You can see right here, their free cash flow grew to $911 million, which is very impressive, and they paid out $268 worth of dividends. During the year, they purchased back 764 million shares, and with a market cap of about $14.4 billion, this is a pretty significant share repurchase program. Now, they should still be sitting on a fairly substantial cash pile, so I hope they continue putting it towards share repurchases that could definitely help the per share metrics over time. Right here, you can see their initial targets versus what actually ended up happening. So their initial target was 5 to 8% of organic growth, and they smashed that, getting 11.7% of organic growth. They were also expecting a mid-10s EBITDA margin, and they got 11%, and they expect to deploy 3.5 to 4.5 billion, but they actually deployed less at 2.7 billion. Now, depending on how you look at this could be either a good or a bad thing. In theory, if the stock price continues to trend down and they have more cash sitting now on the side being able to be deployed to share repurchases, it could have been good to hold the cash on the side and not invest this heavily last year. Now, in my opinion, I honestly wish they would have hit the target. I think there was enough cheap opportunities to buy stock at a discount they should have taken advantage of. Now, for their Q4 summary, the revenue still managed to grow 7.3%, which is a little bit slower rate than the rest of the year, but not too bad at all, and their adjusted EBITDA grew 10.5%. The diluted earnings per share grew 21.1% compared to Q4 of 2024, and the free cash flow grew 51.6%, which is something I'm really happy to see. The only way a company can continue to sustainably return value to shareholders through dividends and share repurchases is by increasing their free cash flow per share at a rapid pace. Now, this is where things get tricky and what investors did not like. So as you can see right here, the revenue projection for 2026, their guidance is between 0 to 4% growth, which is absolutely terrible. Now, these kind of sectors, including the defense sector, can be pretty cyclical at times, so it is understandable to an extent, but a 0% growth rate in such a time would be very bad for the company. Now this could be a case similar to what happened last year where they projected 5 to 8% growth and they end up hitting substantially higher than that. But even if they outperform this 4% right here, the max that they might be able to hit would be 6 to 8%, and even that might be difficult for the company based on these projections. Now for the rest of these, they don't really quantify how it's growing over time. 700 to 800 million in free cash flow is not bad, but I would have liked to see this substantially higher. If you look right here for their fiscal year 2025, they managed to bring in 911 million of free cash flow, so this is still a decline from the previous year. Now again, this could be a scenario where they set low expectations, especially with the tricky economic environment, and they aim to outperform it, but this is still not something I'm too happy to see, and it's definitely a little bit concerning as an investor. Now some good points that they mentioned for the past year was their dividend payout ratio stayed between 25 and 35%, which is really strong. It's a pretty safe area to be in, and we can see here they accelerated their buybacks in the fourth quarter of 2025 at 310 million in share repurchases. In total, for the full year, they're able to purchase back 4.3% of their shares, which is fantastic. And for their adjusted diluted earnings per share, they're keeping it about in line with how they performed in 2025 at between 620 to 655 per share. So I really hope they can beat these numbers. Hopping into my spreadsheet and taking a look at some of their financial metrics, we can see that the stock price has been pretty shaky. Like I showed you guys earlier, it was increasing pretty quickly for the past 10 years and then has recently crashed pretty significantly. Now over time, the revenue per share has trended nicely upwards. Aside from 2013 to 2015 was a pretty steep decline, but since then they performed very well, and earnings per share have increased pretty quickly aside from 2023, but now we're back for the full year to about $6.30 as we saw a little bit earlier on their presentation. In terms of free cash flow, we can see a similar picture here for the earnings per share, which makes sense that it'd be tracking it, and their shares outstanding have been decreasing pretty quickly over time. They've been buying back a lot of shares. Now in terms of free cash flow and stock-based compensation, the free cash flow is very similar to the image we saw here for the free cash flow per share, and the stock-based compensation makes up a pretty small amount of it. It is increasing over time, but not too quickly, which is something I'm okay with. Now in terms of dividend, just ignore the first 2 years because not taking into account the company's stock split, but as you can see right here, it has been growing pretty quickly over time, but in recent years it has slowed down as the growth of the company has slowed down as well. Now, as you can see right here, their net income margin is already fairly low being a defense contractor, which makes sense. But one thing that concerns me is that if the company cuts some of the costs of their contracts down, and if the government gets rid of some of their contracts, this net income margin is going to compress even further. Now their capex is usually not too high. They are a relatively small company, but regardless, a lot of their work is in the software field and intelligence. So because of that, they don't have to spend as much on capex as some other companies. Now overall, just to be honest with you guys, this was not an impressive quarter to me. Honestly, the company performed worse than I thought it was going to, and I was not happy with their guidance going forward. Now that being said, I do still think that Booz Allen Hamilton is a fantastic company that's going to continue doing well into the future. At this time, I plan on continuing to hold on to my position, at least for the next couple quarters as I see how they perform in the next couple earnings reports, and I'll let you guys know if any of that changes. Personally, I believe that $104 per share at a 14.4 price to earnings ratio is a fantastic price to be making a position in the company, and if I hadn't already had a position in it, I would definitely be adding to it or creating a position at these prices. Now, since my position is very large, it's unlikely I'll add more money into it anytime soon, but if it does dip below $100 per share, I may add a couple more shares into my holding. Had I waited a couple more months to buy into the company, I would have had a far lower cost basis, but I'm still pretty satisfied with my current cost basis. I think 5 to 10 years from now, it's still going to be a very good price to have gotten into the company at. Definitely let me know in the comments down below what you guys think. As always, that does bring us to the end of today's video. I really hope you guys enjoyed taking a look at Booz Allen Hamilton and seeing my own personal position and my thoughts about the company. If you guys did make it this far into the video and enjoyed it, please leave a like, it helps me out a ton, and subscribe to the channel if you haven't already. Let me know down below if you are buying Booz Allen Hamilton stock at these prices, and also let me know if there's any specific companies you want to see featured in a future stock spotlight video. If you haven't yet watched the last video where I cover United Health stock and whether or not I'm buying more of the company, check out this video right here. And if you want to see my dividend income for the month of April, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.